Welcome to Market View with Ike Iosa and Friends. The show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Well, good morning. Mike Iosa, your host for Market View guest, my very good friend, Mr. Mark Arbiter. Hi, Mark. How are you?
Great, Ike. How you doing?
I'm doing well. And I'm going to ask you a question I asked another guest. It has to do with the spectacular rally that we got the last 5 weeks, 500 points in 5 weeks. So the question is, after such a spectacular rally, what do you do for an encore?
Yeah, generally what we're seeing here, we don't get these often, but we've had a V bottom, at least on the right side of the formation. Call these lockout rallies. Every now and then we had one after the pandemic. We had one in, I believe it was 2014. They're not very common. They're difficult to trade, but they tend to be very bullish from an intermediate to longer term perspective. And to me, that suggests with the other data that we've seen with market breadth and all the breadth thrusts we've seen, and this kind of the spreading out of the rally from the top 7 or 10 stocks to many other issues which have lagged quite a bit this year, that the technical outlook looks very good. We go to the first chart. This is the daily of the S&P 500. You can see that we've run up to the last high from July, which goes up to about the 4,600 area. So we're in an area of chart resistance or overhead supply. There's wasn't a lot of price action between 4,500 and 4,600. So we may get a pause here. The bullish factor here is that we've gotten overbought 2-hour, 4-hour charts, which have shown some divergences. We've been overbought on the daily, and all we get is, a pause or a flag, maybe one dip. So these types of markets are very hard to trade. So you just hold your nose and buy, because everybody, wants that nice 3 to 5% pullback to raise equity allocations, and we never get it. Well, we get it much later than people think. Based on the V bottom, the structure of the V bottom, and the completed inverse head and shoulders that we saw here in November, there's a measured move target to the 4,700 area. We're basically up to the 4,600 area. So based on those formations, we have a little further to go. If we move to the second chart, this is a weekly chart of the S&P 500 going back to the peak back in early 2022. It shows the bullish channel that we've been in since the October of 2022 lows, bear market lows, and we are approaching basically the last Fibonacci retracement of 88.6%, which is up at 4668, right in between that 4600 to 4700 area. So that's an area to watch. Generally, when you exceed 61.8% of a decline, you end up with a full retracement and then a move to new highs, which is what I would expect. Moving to the third chart, this is the S&P 500 weekly with the weekly Bollinger Bands. During the bear market, we had 3 different touches of the lower band, which in a bull market is a buy signal, but 3 in a row did not work. Clearly, after the first didn't work, we knew something was off, because this is a pretty reliable, unless you're in a big bear market, these are pretty reliable buy signals. A touch or a break below that lower weekly Bollinger Band, and then a recapture has been a great buy signal over the years, and that's exactly what we got here in the later part of October. What I would want to see here is an expansion of the upper band as we get up towards that upper band, which is around 46.58. And then if we're truly in a new phase of this bull market, if you look back to 2020, 2021, generally when the market is in a strong bull, you'll ride up along the upper Bollinger Band and in between, and you'll correct down to the middle band, which is just a 20-week average, and then you'll just ride that channel for months to years. So that's what we'd be looking for here. Moving to chart number 4, we have some encouraging market breadth. On the top, we have the percent of OEX stocks above their 200-day. We got very oversold back in October of 2023. Now, of course, we got very oversold during the bear market in 2022, but we recovered from the recent October lows around 24%, all the way back up to a bullish reading of 72%. As I've said before, any move below, I like to use the 45% level, and a consistent move below 45% equates to, danger. Majority of the bear is still to come. During bull markets, extended bullish runs, we generally get up above 70, can go as high as, above 90, but you'd like to see us just stay consistently above the 70% level, and that shows that the majority of stocks are in uptrends. If we go to the bottom panel, that's the percentage stocks on the NDX or the QQQs above their 200-day. They did not get as oversold in October, came down to about 40%, and they're also back up to 72%. So we're finally seeing some longer-term improvement, nice improvement in market breadth. Moving to chart number 5, this is also a weekly of the S&P 500 as well as the NDX. S&P 500 on a weekly is on the top panel, and then the second panel is the advanced decline line of the SPX. And you look and see it's very close to hitting an all-time high. Probably will do so before price does. And when breadth leads price, that has generally, historically been bullish for the overall market. If we go to the bottom two panels, the AD line of the NDX or triple Qs has already reached an all-time high prior to price. So that's, as I said, that's a bullish sign. So breadth is lining up here for another run for the overall market to the upside. If we go to chart 6, this is a daily of the 10-year Treasury yield. You can see I marked out, we had a head and shoulders top, basically completed a measured move based on the size of the head and shoulders, and we've moved into, we're starting to move into some important areas. You can call them support, but if we were looking at the price chart of the 10-year Treasury, they would be resistance, but be that as it may. Down near 420, we have prior levels where we hit back in 2023, earlier this year. 50% retracement of this move since April is around 4.1%. And then we have the rising 200-day around the 4% level. So I think for low fours would be an area where we stop and then turn back higher. This has been one of the main impetuses of the strong equity rally, lower yields across the curve, 5-year, 2-year, but more so on the longer end. We go to the second panel, the other bullish factor for stocks, and especially metals has been the decline in the U.S. dollar. So we had a kind of a perfect storm here for the stock market. And, looking backwards is always easy. Falling dollar, falling yields. We had so much fear about, 5% on the 10-year and the 5-year going much higher. And that's exactly what didn't happen. So that has aided stocks quite a bit. Moving to chart number 7, this is a weekly of the 10-year yield going back to the bottom in the pandemic, early 2020, down near 0%. So we've had quite a run, 0 to 5% over the past 4 years, And right now we're pulling back. You can see we reached the prior high here from back in 2022. The 40-week moving average comes in around 4%. That's similar to the 200-day, so that'll be a key level. And just a simple 38.2% retracement of the move off the secondary low in 2020 comes in around 323. That's also the bottom of the range where we traded from late 2022 to past the middle part of 2023. So I think that's an area where over the intermediate to longer term, we will probably stop between 323 and the 4% area, and then, potentially start to head higher. We're definitely in a longer term move higher after 4 decades of yields going lower. On the top panel, this shows how overbought yields got just using a 14-week RSI. The first overbought reading, or the peak, was around 82. And remember, this is a weekly chart. And then we went on to get overbought over 73 other times. So we had 3 negative divergences. There would be positive divergences on the price chart before we peaked, if this was a decent peak. So this just shows that markets can get overbought and, stay overbought for a long time. Just because you get overbought doesn't mean a move is over. Just because you have one divergence, and a weekly divergence is much more important than a daily. So it's not until the price turns that you would get your sell or buy signal. But certainly we had warnings. The momentum was peaking, but it took a number of times till we had this pretty quick move lower.
Mark, anything else you would like to add?
Yeah, I have 2 charts of gold. First is gold futures on a continuous contract. I think we're trading today around 2,090. So we clearly broke these prior peaks, which were almost exactly the same here from August 2020, March of 2022, and May of 2023. So this is a pretty important, if it sticks, a pretty important breakout for gold. Could equate to a move 2,400 on gold futures. This has certainly been aided by the dollar, and that the assumption is the dollar will continue to go lower. If we go to the last chart, we go all the way back to 2009. This is a monthly of GLD, the Gold Shares ETF. This looks like, and I've shown this before, it looks like a massive cup with handle here on the monthly chart. If so, the targets, this is a much larger base than the one I just showed. The targets for GLD would be up in the 250 to 300 range, which would equate to 2,500 to 3,000 on gold futures. So for now, the gold bugs are going to run with this. And when gold has gotten hot in the past, and there's been a couple massive moves, it probably won't matter what the dollar does. They tend to get into these parabolic moves that can last for years. So the gold setup looks pretty darn good from a intermediate to longer term perspective.
Mark, thank you. Have a great day.
Thank you, Ike.